Oh, hi, Melanie. How you doing?
I'm good, Professor. How are you?
Good. Hi,
Wonderful.
Ian. Welcome back, man.
How's it going, Professor?
All right. We have a Brianna sighting. Hi, Brianna. There she is.
Hello.
All right. Looks like we're all rolling here. Just give me one moment. We'll wait a minute or so to see if we get any more spectators today. I should say spectators, students. Okay, allow me to find the right PowerPoint. Hey, how you doing, pal? Is that your daughter or son, Brianna?
Yes, I have two boys, 3 and 5.
And three. Do you mind if I do something silly before class here? You ready, kids?
You ready?
Ready? Da, 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 da. Da, da, da. Babies love that. Your son is saying to himself, "This guy's a teacher." Oh my goodness. Okay, I gotta run here. I gotta find the right. Come on, come on, come on, come on, come on. Come on, come on, come on, come on. Okay, we got that one. Got to find one more here. And then we'll get going. Come on. Getting there. Okay, now I think we have it. Oof. One more time. Okay, finally. All right, I've come back. Okay. In the last class, we went through chapter 2 in great detail. And we also went through chapter 3 in pretty good detail. I'm going to take us through chapter 3 again more quickly than we did the last time. And I want to end up by going through chapter 4. In other words, we're going to try to keep ourselves a little bit ahead of the class. And I think we're ready for that for what I'm seeing. So let me set this up. And I better remind myself to edit out the first few minutes of this clip, unless my boss sees them. Okay. Understanding the business, huh? The business cycle. These are 3 terms that'll probably be on a test, and they're pretty easy to conceptualize. The time period concept. It's a gap concept that a business can be broken down into a finite period of time, typically a month, okay? Recognition issues. When should things be recorded? We're talking revenues and expenses, recognition concept, and the measurement. What amounts should be recognized? Our income statement, we should know by now, sales or revenues less expenses gives you a net profit. Net operating profit. Operating profit, revenues minus expenses gives you what's called operating profit. meaning the profit you earned from what the business normally does. Target sells merchandise. The money they make from that would be called their operating income. If Target invested in other companies and sold stock or something, had gains or losses, that would come after operating income. And after subtracting that, you'd be the bottom line net income. Here's a real good example here of a consolidated statement of income. Consolidated means Chipotle might have an income statement for North America, South America. This is the total of the whole company here, and it's in thousands. So Chipotle in 2011 sold $2 billion worth of Mexican food, huh? Their sales were there minus the operating expenses, total operating expenses, net income from operations. If you're an investor, this might be one of the first things you're going to look at. You're going to look at this probably before you look at the net income, because the net income contains things that are not part of the core of the business, especially the 30% payroll tax, not payroll tax, income tax. Let's understand the difference in expenditure versus an expense. And an expense is an activity, is an operating activity, we'll say. An expense is you got the electric bill in the mail, you used electricity, you paid your employees. Those are expenses. An expenditure is an outflow of cash. An expenditure means that you spent money. Don't care what it's for. Some of the operating expenses of a restaurant, guess what? Food, beverage, packaging, etc. We're not going to worry about the international perspective. Cash basis, we're totally ignoring this. Totally ignoring this. Cash basis is not GAAP accounting. Cash basis income statements and financial statements are worthless in terms of being able to borrow money from a bank or attract investors or measure what your business is doing. You run a business cash basis, I'll tell you, you're going to cash basis yourself out of business immediately. Accrual accounting, that's our ball game. Accrual accounting. Revenues and expenses should be recorded when the transaction that causes them occurs. On December 31st, we sold $1 million worth of Mexican food. Wow, we had a big New Year's party we catered. Well, we're not going to get paid until the end of January the next year. The sale occurred in December, and so that is where the sale or revenue belongs. It belongs as a sale in December, and the payment a month later is irrelevant, okay? And accrual accounting is GAAP. Here they talk a little bit about when to record revenues. When to record revenues. It could be when the food is delivered. It could be before, it could be after. The key thing is when the food is delivered is when you record the income, regardless of when you pay for it. Here, cash is received before. We're Chipotle's. We got a check in the mail for $10,000 to cater a party at the college next month. And we took that money and we put it in our Chipotle bank. We debited, I don't say debit yet, but we did, we're up to that. We debited cash and we credit a liability account called unearned revenue. Okay, that's a liability. We, Chipotle, don't owe the school money. We owe them food. And what happens when they cater our fare? Well, we're going to debit this liability to decrease it, because we know liabilities go up with a credit balance, and we're going to credit a revenue account of some kind. Cash, when it's received on the date of the activity, well, that's the simplest of all worlds. I ordered a bunch of pizzas from Domino's for a faculty meeting the other day. Domino's came in with 3 pizzas. I paid the guy and he walked out. Everything happened at the same time, the cash and the revenue. In that case, they just happen to coincide. The revenue principle again. The company delivered the pizzas to another place, and they trusted that other place to pay them later. So they delivered the pizza. The moment they delivered the pizza, that's revenue. They're going to get paid later. Accounts receivable. The revenue principle. And then when they get paid, cash is going to go up with a debit and receivables will go down with a credit. The revenue principle. Let's talk about expenses. The matching principle. Probably the most important, I would guess, principle in accounting, because if you're not matching your revenues and expenses properly in the right fiscal period, you're coming up with income statements and balance sheets that are not correct, and good God knows where that could lead, huh? The expense matching principles, costs incurred to generate revenues be matched up in the same period, huh? When Chipotle's provide foods to customer, revenue is earned. The cost of generating the revenue would be the expenses involved in doing so. Matching principle. Here, the cash was paid before. Okay, we're still Chipotle's, okay? We went out and we bought $10,000 worth of straws, okay? Straws. And those straws are not going to be used until the future. So we're going to call that a prepaid supply, an asset. An asset. The next month, we go out and we look at the straws and we see we've only got $1,000 worth, say. That would allow us to calculate what the true supplies expense is. Prepaid expense, we debit. These are our straws. And then when we use the straws, we will debit supplies expense and credit the prepaid. And I'm going to remind you again that one man's prepaid expense is another woman's unearned revenue. Let's think about that. We purchased this prepaid asset, okay? To us, it's an asset and we credit cash. To the party who sold this to us, that would be unearned revenue and a debit to cash. One man's prepaid is another one's unearned revenue. The matching principle. Here, very simple. The expense and the cash occurred at the same time. We called in on somebody to fix the copy machine in the faculty room. Guy came in from Xerox and he changed a part. And he said, that'll be $50, please. We hand him $50 and off he goes. Revenue, not revenue in this case, the expense occurred when he fixed the machine. It's just a coincidence we paid him. Here, we paid him afterwards. The guy came in, and this time he handed us a bill for $50 with the understanding that the school will pay it in 30 days. So the expense goes up and the payable goes up. The key thing is that the expense is going to be debited in any event, regardless of when the cash changes hands. And here, when we pay the guy, the cash is going to go down, of course, and the payable goes down with the debit. The debit. Management's incentive to violate accounting rules. These are some famous fraud people we've seen before. But the one guy who was pretty bold, this guy here, Bernie Ebers, he decided that every penny he spent was not an expense. And he put it on the balance sheet. He would pay his employees and he would debit something like inventory. And anyway, it was such a bold, ridiculous scam that he got drilled for it. Okay. The expanded transaction analysis, huh? Now we're getting into the debits and credits, and we just need to get these straight in our head, huh? Assets, increase with a debit. The greens are increases. Assets increases with a debit. Assets increase with a debit. That means that any asset has what's called a normal debit balance. At the end of any period, at any point in time, you would expect to see a debit balance for an asset. So at the end of the month, if you have a debit balance in cash of $10,000, that's what your checkbook says. That's what your general ledger is telling you, that at that point in time, you have $10,000. And it's a debit balance, so at least that part is okay. But suppose the month end and you found you had a credit balance in cash. Well, that indicates something not right. Did somebody rob you? Probably not. It's probably an accounting mistake, a misposting of some kind. Or you're forced to play the float check game like I had to do and so many other people do. At the end of the month, you had $10,000 in the bank, but you wrote a check for $25,000, even though you don't have the money yet, knowing the money's going to come the next day to cover it. So credit balances and assets, no good. Assets, debit balance, which means liabilities, and all equity accounts would have credit balances. Now, what do we mean again by the normal balance? The side of the T account, left or right, and that's all that means, which increases the balance, okay? So they're looking now at retained earnings. Retained earnings, that's part of equity. At the end of the month, we are going to close out the income statement. We're going to go, and this is part of chapter 4. We're going to close out the income statement by taking the net income, which is the revenues, minus the expenses. That would be our net profit. So your net income or net profit increases retained earnings, which is a capital account, okay? Your equity account. If we gave out any dividends, that would decrease it. Retained earnings at the beginning of the company's existence, they opened the business, they had no retained earnings. They hadn't earned any money. At the end of the first year, they earned $50,000 net income. That increased their retained earnings, $50,000. Next year, they earned another $25,000. Now retained earnings is up to 75, etc. So retained earnings is the part of the stockholders' equity family where net incomes are added every month on the credit side. Suppose, though, that company said, we've had some pretty good success. Let's reward our shareholders with some dividends. A dividend, by definition, is the act of reducing your company's net worth by giving away an asset and getting nothing really in return. So assets, so dividends decrease retained earnings, net income increase. I'm going to go through these transactions a little more quickly than I did in last week's scenario. Under the chapter 2 lecture, there's a pretty good look at this chapter as well. So let's go through it and then hopefully get into chapter 4 and really have some fun, okay? Let me get this out of the way. Chipotle purchased food, beverage, and packaging supplies, $207,700. Well, that's a lot of packaging supplies. And they paid it in cash for this amount. And the supplier agreed, okay, and you can pay me the balance of $40,000 in the future. So what's happened here? Our asset, take a look at the T account. Our asset went down, the cash asset went down, but the accounts payable went up. Offsetting that is the increase in prepaid supplies. We purchased prepaid supplies, $207,700. That increases supplies. We had to reduce cash with a credit and increase accounts payable with a credit. And I know many students are going to be fighting the debit credit world for a little bit. At the beginning of January, Chipotle paid in advance for 6 months of rent. They paid in advance. They debited prepaid rent for 80, well, prepaid expenses. It's various different expenses, but let's pretend this is rent. They debited prepaid rent, say, for $86,000, an asset to be utilized in future months, and they reduced cash with a credit. I'm going to take us to the reciprocal. We debited an expense, we debited an asset and credited cash. The people who sold us the rent, the landlord got our cash and debited cash, but he couldn't claim that as rental income yet. He has to call it unearned rental income or unearned income, because he can't claim it as income until I or you, whoever occupy the apartment, huh? Sold food. We sold a lot of food. I always chuckle at this slide here. We sold $615,300 worth of food, and we only gave credit to people for $4,000. Everything else makes this a cash business, $615. So look at your T account. We started off with $349. We had that big cash infusion up here, $615,300. Here is the accounts receivable going up and the revenue. Sent some employees out for training, management training, very common expense. Operating expense, we debit that expense and we credit the cash. So we have an expense here, $49,300. Cash went down $49,300. Uh-oh, we have to pay our employees. And note what it reads. Chipotle paid employees who worked this quarter. Employees who worked this quarter, we paid $138,600. Those are the people who worked from the first of the month to this point in time. But you notice it says they also paid last quarter $91. That's because that amount was recorded last quarter as a liability in the accrued payables account. We're going to get to adjusting entries hopefully in a little bit. Again, cash is going down, and also the accrued liability has now been cleared out and the expense went up. Sold some land. This is the one we talked about the other day when we had a question on how we came up with the gain or loss here. The land cost them $11,900. So that's how much has to come off their general ledger. That's what they had on the books. And it's telling us that they took a loss of $1,300. So that means that they only received $10,600. That's a good item to look at, that transaction. Makes you think a little bit. Customers are paying us now. That $4,000 of credit we extended to customers, someone's paying us. Cash went up. Another asset went down, accounts receivable. During the quarter, Chipotle paid suppliers $37,200 on account. Whenever you see that a transaction says on account, you know that was because nobody had money at that time. So now we're going to pay off that accounts payable. When they bought these supplies, they debited prepaid supplies and credited accounts payable. Now we're reducing the accounts payable with the debits and crediting cash. Okay. Utilities, maintenance, basic occupancy expenses, $10,000 for occupancy, and they're calling this 48.6 other cash paid. I think that's a pretty easy one. Nothing to worry about in terms of payables. They received cash as investment income during the quarter. Well, that's nice. But expense investment income is not an operating income. Chipotle's business is not the stock market. They're not a, they're not a trading company. They make food. So this would be an example of a gain or a loss. This would be called investment income. And that income account, of course, goes up with the debit. Cash goes up. I'm sorry, the investment income goes up with the credit. Cash goes up with the debit. That income would come after operating income. Gift cards. We all love gift cards. I love getting them myself. Gift cards. Chipotle sold gift cards to customers for $15,400. They expect them to be redeemed in the future. Experience tells them it'll take about 3 months before people use these. But until people use them, it's not income on our income statement. It's nice that we received cash up front, but it created a liability. So we have to wait for people to come in and use these gift cards to record the income. Let's take a look here. Now we look at the ending general ledger. These are T accounts, but it's your general ledger. It's mimicking the general ledger. So at the end of the month, we have a balance here of $370 in cash. And the way we got that, we add the beginning balance plus the debits minus the credits. And just a quick look, here are our assets. They all have debit balances, so at least that part is correct. Here are our liabilities. They all have credit balances. So do these liability accounts. And same thing with the dividend, with the common stock and the paid in capital. Here's the income statement side. Operating income, $619,300. That was money we made selling food. The investment income, well, we're going to add it to that, but that's not part of operating. Salaries and expense. Our expenses all have debit balances, so I guess that's something to be said for that. We'll go through the process of preparing the 3 financial statements. They must be done in the proper order, which you see here. Income statement is done first, simply revenues minus expenses. We need to do that first because that net income is going to be plugged into this little 4-line template we need to know very clearly. When we know the net income, we know that's going to increase retained earnings. So our statement of stockholders' equity is the beginning balance in retained earnings plus net income minus dividend equals ending. If you like acronyms, you got to bide your time. BIDE, beginning income dividends ending. So we take the beginning retained earnings, we add the income, we subtract the dividends. That gives us the ending retained earnings balance, which we will then simply move to the equity section. Here is a report you prepare at the end of the month. All companies do this, called the trial balance. And notice it says unadjusted trial balance. The only thing this unadjusted trial balance does for us is verify that debits equal credits, okay? And I'm chuckling because I don't think you're ever going to run into that problem in the modern computer world. The old days, yeah, that could be a real pain in the neck. Here's our income statement. Our income statement. We had sales of $619, and then we had various expenses, $138,610. 10. Where did we get those numbers? We got them right from the general ledger, 619. I see 619. I see salaries, 138,610. $138,610. There's the 48. Sorry, guys. And that gives us operating income of 372 because these are operating expenses. And by the way, hey, Ian,
What's up?
how did Chipotle ever sell $619,000 worth of food without having any food expense? Kind of goofy, huh? So I think they might have missed something there. Notice the investment income of 4,700 is below the line, as we like to say, below operating. And the gain or loss, the loss W, whatever that is, was from selling that fixed asset. Okay. So investors, first thing they're going to look at, income from operations. And they could say, okay, wow, this company gets about 60%. They have a profit margin of about 60%. Let's look at that profit margin, though, using the net income. This is a real important basic metric. Net income divided by your sales gives you a percentage, and that is called the net profit margin. In this case, 215 divided by 2269 equals that decimal, or as a percentage, about 9.5%. So Chipotle earned 9.5% on their sales revenue. It means that for every $100 they sell, they keep for themselves $9.47. Okay, basic metric. Cash flows we're not going to worry about. Okay. So here, what I would like to do is get into chapter 4. Okay. Even though we're getting just a little bit ahead of things. So give me a moment to pop up chapter 4 here. I've got it right in front of me. Chapter 4. Chapter 4. Okay. Okay. At this point, we are now even with the syllabus, okay? You now have 2 different presentations on chapter 3. This one and the one we did last week at the end of the session, okay? So let's go into the world of adjusting journal entries. Adjusting journal entries. And this is interesting, a little tricky though. This is where we're going to have to concentrate a little bit and get an understanding of what we're trying to do. Management is responsible. We understand that. Management is responsible for these financial statements. You can't blame the auditors. You can't blame other employees. It's management's responsibility. Take a quick look at this grid here. At the beginning of the fiscal period, you're going to be analyzing transactions every day. You're going to be looking at the payroll. You're going to look at expenses that came in. You're going to be looking at contracts and different things. And you're going to be recording journal entries in the general journal, which is how we do things in this course. And then you're going to post those amounts to the general ledger. That's chapter 3. That's what we just did. Okay. We looked through about 10 or so transactions from Chipotle, everything from buying supplies, paying their payroll, selling food, buying things. The month is now ended. Welcome to chapter 4. Chapter 4, we now are going to, at the end of the month, prepare the trial balance to make sure that the debits equal the credits. It's kind of pro forma. You're not going to have that problem. Okay, now we have a trial balance with all the ending balances. And by definition, that trial balance is incomplete and thus incorrect. Because there are certain journal entries, certain activities that can only be recorded at month end. So typically, October 31st arrives and you run the trial balance. Then you may have a couple of days, maybe even a week if your company's generous. You have a couple of days to prepare the necessary adjusting journal entries. So you can do this work November 1st, 2nd, and 3rd, but you're going to tell your general ledger system that you're doing it in October 31st, okay? Run a trial balance, then you adjust. And once you've done that, you're going to come up with a corrected and complete and fully adjusted trial balance, which you will use to prepare the financial statements and ultimately close, okay? So let's give this a little shot here, and we'll hit it again hard on on Friday, an unadjusted trial balance, listing of all the accounts in financial statement order, always in financial statement order and chart by the chart of accounts. That's all it is. Debit, credit, okay? Here we go. Here's our first look at adjusting journal entries, okay? Let's see what we have here. Well, they break them out into a couple of categories. They talk about deferred revenues and deferred expenses. So let's start with those. Let's start with deferred expenses. Deferred expenses. Previously recorded assets, the prepaids, all the prepaids. Previously recorded assets such as prepaids that were created when cash was paid in advance and that must now be reduced for the amount of the expense actually incurred during the period. That's a long-winded way of saying we bought an insurance policy and that policy doesn't kick in until next month. So when we bought that policy, we debited the asset called prepaid insurance and we credited cash. And then the next month, we record the insurance expense because that's when we had the insurance, a deferred expense. Remember what I said about a prepaid expense being the same thing as unearned revenue? Let's take a look at that. Here, we bought an insurance policy. When we bought it, we debited prepaid insurance, the asset, and we credited cash. Now, here's the people who sold it to us, the deferred revenue guys. Deferred revenue is your unearned revenue. So when we credited cash, this guy debited cash and credited unearned revenue, the liability account. So we debited cash when we bought the prepaid insurance. We credited cash. This guy debited cash. We debited an asset. He credited the liability account. So that's our first of the two types of adjusting journal entries. Let me say this, that might help you get a little more clarity. A deferred entry, deferred expense, or a deferred income means that nobody did anything. Deferred means money changed hands, but nobody has done anything yet to earn the money. That's what a deferred is. Money changes hands, but the future expense or revenue is just that in the future. And that's our adjusting entry. The other side of the table are accrued revenues and accrued expenses. Accrueds, think of it this way. Accrueds means no money involved, no money. In fact, you might not even have any paperwork. Nothing's happened. Or rather, something's happened, but you haven't recorded anything. Let's start with the accrued expenses. These are the most common. These are expenses that have been incurred, but not yet recorded. The month ends, and you notice that you don't have any electricity expense on your trial balance. Well, you know you used electricity during the month. You may not know exactly how much. You also know you can't wait for the electric bill to come in 25 more days. The public is demanding to see your financial statements. So guess what? You're going to have to estimate a number. Yes, financial statements have estimated numbers. And there's even a gap term to describe the process. It's called systematic and rational. The month ends, we have no electricity expense recorded, but we have to come up with a reasonable number. Well, out here in the Central Coast, we don't have much of a fluctuation in the weather. So the electricity last month was 1,000. The month before it was 1,100. The month before that, it was about 950, etc. we think it got a little colder this month. We're going to accrue maybe 1,200. That's a reasonable number, systematic and rational. So the accrual entry is going to be a debit to electricities or utilities expense and a credit to an account called accrued payables. An accrual is a temporary payable. An accrual is a liability. Adjusting entries. How does the accounting system record these, huh? It's all about timing. Revenues are recorded when they're earned per the revenue realization principle, or as I like to call it, the matching principle, and expenses are recorded when they're incurred, matching principle again. Assets are reported at the future benefits amount. Liabilities, the probable future payments, okay? Companies wait until the end of the accounting period to adjust, because adjusting the records daily would be very costly and time consuming. Do we really want to adjust every time someone sells us an insurance policy? No, we want to wait until the end of the month to do these type of things, okay? Adjustment process, I'll just go through this. This is a busy slide, too busy for me. We want to say to ourselves, was revenue earned or an expense incurred that's not yet recorded? And yes, by definition, there will be some. Well, if it's yes, credit the appropriate revenue account, debit the appropriate expense in the adjusting entry. Was the related cash received or paid in the past, or will it be received? These are the questions we ask to guide us on the journal entries, okay? That slide is too busy for me. This here is a much better look at what we're trying to understand. The month ended. The month ended. Deferred revenue. Remember what we said. Deferred means the service or the delivery was deferred until later. Deferred means it's going to happen later. Cash changed hands. Nobody earned anything. So let's see what we have here. We earned some revenue now. We earned revenue. So now we're going to reduce that unearned revenue. We purchased tickets to a concert 3 months ago, okay? Or somebody paid us in advance for a concert. We're concert promoters, huh? And we debited cash. We credited the unearned revenue. We owed the concert. And then when we provided the concert, that's when we can recognize the revenue with a credit to revenue and a debit to the liability. We have taken care of that liability. Here, we're accruing revenue. Well, what kind of revenue do you accrue? Typically, what we're talking about is interest income. We loaned money to somebody on December 31st. We loaned them $12,000 at 10%, meaning 10% a year or $1,200 a month. Well, they're not going to pay that until over a year later, but each month that revenue builds up, and we are going to record revenue. We're going to record interest receivable and credit interest income, okay? Let's look at the deferreds over here, the deferred and the accrued over here. A deferred expense, change deferred to prepaid, if you will. Maybe that'll make it a little bit easier. The deferred expense is the action of reducing the prepaid account by the amount that it was consumed. Prepaid expense. We bought $1,000 worth of supplies at the beginning of the month, and we debited prepaid expense and we credited cash. At the end of the month, we go out and we find out we used all of those supplies. They're gone. We used them. That $1,000 is now an expense because we used those supplies and the asset is no longer there. Again, this is a reciprocal. The two deferreds go together. Prepaid expenses, same thing as unearned revenue. Deferred expense, okay? Deferred expense. This is where we paid for something and, well, this is the prepaid right here. I got myself a little mixed up with that. I wish the headings were on top and make it easier for me. The deferred expense is what we just talked about. We're reducing the prepaid asset and crediting the expense in the future month. Now we're talking about the accrued expense. And this is the most common type of adjusting journal entry, probably. The best example I can give you, I just talked a little bit about electricity. You're all working people. You've all earned paychecks, huh? Probably still working. You worked from December 25th, Christmas Day. Your boss was a hard guy. He made you work from December 25th through the 31st of the month. That's a 7-day period. You earn $100 a day. So at the last month of the year, you earned $700. That's when the activity occurred, and that's where that expense belongs. So your adjusting journal entry is going to be to debit wages expense and credit accrued wages payable. The reason for that is you're not going to get paid that day for the work you did up to that point. When you joined the company, one of the first things they told you was we hold back a week's pay, meaning we'll pay you a week later. But you must record that expense, and just as importantly, you must accrue that liability, because the company really does owe you the money at that point in time. If you quit at the end of the year, they have to pay you right then. If they let you go, they have to pay you. If the company burns down, they have to pay. They owe you it at that time. You're just acquiescing to their policy. I'll wait a week for my paycheck. So as we get toward the end here, we're looking at an unadjusted trial balance. We have not done any adjusting yet, huh? Okay, so we're kind of looking at this here. And there's a few things I don't see. I don't see any supplies expense, do you? I don't see any insurance expense. So there may be something we need to do, okay? Here's another grid, might be helpful. This is a good way to look at things, huh? Deferreds, money changed hands, nobody did anything. Accrueds, something's happened. We need to record it, but there's no cash yet. Unearned revenue. Unearned revenue. Was revenue earned yet? Here is the first example of your adjusting journal entry. This is the unearned revenue adjusting journal entry. You debit the liability to reduce it, and you credit the revenue account called restaurant sales to increase it. Unearned revenue. And here it is in T account form. The amount of revenue that was earned is given as $21,300. Let's take a peek back at our trial balance. At the end of the month, $33,400. Maybe that's $33,400 worth of gift cards. Gift cards. So when we sold those gift cards last month or 2 months ago, we debited cash and we credited this liability account called unearned revenue. Now we're being told that customers brought back $21,300. So we don't owe $33,400 in gift cards anymore. We're going to reduce that by the $21,300. And that becomes revenue, sales revenue. You following, Melanie?
I just had a quick question.
Go for it.
I remember that when the pandemic first hit, in order to help businesses, a lot of people were saying you should go and buy gift cards or gift certificates for future use. Would that have actually helped the businesses, or would it not have, since it's technically unearned revenue?
Okay, so your question is, are gift cards good to sell, is what it sounds like you're saying.
Yes, I think so.
Well, yeah, that's a great question. And I'm going to talk about it for a moment here. Also, I hope to be able to assign you an interesting article on how companies now have to treat gift cards, accounting wise. Yeah, companies sell gift cards. They sell them and customers don't use them. Okay. Well, do you think that makes the company happy if nobody uses their gift cards? It's
No.
easy money, right? No, of course not. They want people to use those gift cards. And why is that, Melanie?
Well, because it technically is unearned revenue until you cash in that gift card, and then when you do that, then they finally receive some sort of revenue in return,
Well,
right?
that's one reason. That might be the biggest reason, but I think there's an even maybe a bigger reason than that. Why do companies want you to come into their store with a gift card? Have you ever gone into a store with a gift card and not spent any more money?
No, I always spend more money.
Yeah, that's the whole point with gift cards. You know, if someone gets a gift card for $100, they go to Chipotle's and they say, hey, I have a $100 gift card, lunch for everybody. And the bill might come to $120. You get the idea.
Right.
You know, you go into a department store and all of a sudden, you know, you see things. So gift cards are quite attractive to companies. They love to sell them and they really don't want people to leave them in a drawer unused.
Right, of course.
Unearned revenue. Here's an accrued revenue. Accrued revenue. Accrued revenue. Here we have interest. They're telling us that an investment owned by Chipotle earned $200. Wow. We're not going to get paid yet. This is just interest building up. We debit interest receivable and we credit interest income. That's a pretty easy one, huh? Debit the receivable, interest receivable. So it's $200 a quarter, apparently, which is $800 a year. So they're going to write this entry 12 times over the year, whatever, to come up to $800. And then the following year, the borrower pays us back plus this $800 in interest. Accrued revenue. Again, here is the T account world. At the end of the month, we looked at our investment income column and we didn't see any income. We saw this number here, but that was already done. Here we're recording interest receivable, crediting interest income. Deferred expenses. This, I think, is the easiest of the adjusting journal entries. A deferred expense means that you are going to credit a prepaid account, huh? A deferred expense. Those are the prepaids. Prepaids. So supplies for the month included food, beverage, and paper products. At the end of the quarter, Chipotle counted $10,000 in supplies. They sent you out, Melanie, and you had to count all the straws and the napkins. And you came back and said, there is $10,000 worth of supplies sitting there. And you look at your financial record and say, oh, wow, we have 216,600 on the records. That simply means that you consumed $206,600 worth of supplies. And that must be recognized as an expense. The expense goes up, the prepaid account goes down. Prepaid account goes down. Wow, they're even showing you a little calculation on this, huh? At the beginning of the month, you had $8,900 in supplies. That's your beginning balance, which is, of course, also the ending balance for the prior month. You went in and you bought 207,700 more, and that gives you 216,600 unadjusted balance. You went out and counted, subtract, that's where we came up with that number. Okay? Deferred expense. Here's another deferred expense. Here, they're talking about different things. They're talking about 36,000 was paid at the beginning of the quarter for rental of 6 per month, 32,000 for this, 20. So at the end of the period, they're telling us that we have $46,000 worth of occupancy expenses that we can now put into the expense column because we've consumed the prepaid. Let's see where they get the $46,000. Hold on one second. 46, the 20 at the beginning of the quarter, maybe 20 to 52, the 20 and the 36. Okay. Yeah, the 20,000. No, that's not right either. I really don't know where they got that $46,000. Okay. That's your assignment. You figure it. No, you can't. The slide doesn't quite give us enough information. Prepaid expenses, huh? Prepaid. Take a look at the general ledger. We had a balance of 113,700. We consumed 46. Oh, thank God they're giving us the answer on the 46,000. The rent was for 3 months. Okay. 3 months, and half of it was prepaid. So 18 was for this quarter. They prepaid this for 3 months. 12, they came up with the 8. So there's your calculation if you're interested. Prepaid expense. At the beginning, we had that amount, and now we recognize this expense of 46,000. Prepaids are always going to be a debit to an expense and a credit to a prepaid expense account. And here's our last adjusting journal entry, and this is the easy one. This is the one you pray that is on the test a lot. Depreciation, okay? We bought a truck. Property and equipment. These are big purchases. They are not expenses. They are assets, long-term fixed assets, they're called. Assets that are going to be around for a number of years and hopefully give us benefits every day. Companies are allowed to record what's called depreciation expense. Depreciation expense. It's the concept that the machines wear out over time, and companies are given a nice tax benefit by being able to depreciate their equipment. And the reason I said this is the easy one is because the debit and credit is always the same. It's always going to be a debit to depreciation expense and a credit to an account called accumulated depreciation. So an asset was bought for, say, 100,000. It gets depreciated, and the net book value goes down. We're going to talk about that. To keep track of the historical cost, the amount that has not been used is not subtracted directly. That's a long-winded way of saying this. You see that truck? We probably paid $100,000 for that truck. That truck will always remain $100,000 on our ledger. That number will never change because everything on our balance sheet is at historical cost. So that truck is going to be there forever at 100,000. But we are allowed to depreciate the truck. How do we do it? We're going to debit depreciation expense and credit an account called accumulated depreciation. Say hello to your first contra asset. It's called a contra asset. From the Spanish word meaning contra. We all know what contra means. The opposite, okay? That truck that we purchased for $100,000, that asset is going to stay 100,000. That asset will always be at 100, but we will then record depreciation expense and credit this contra asset. Contra asset, that's what that X means. So what's happening is the truck is always 100,000, but the contra account is going to grow and grow and grow until the truck is fully depreciated. The difference between the original cost of a fixed asset and the accumulated depreciation is the net book value. And we have a big chapter on that, chapter 7, I believe. Chapter 8. Take a look at the T accounts. They gave us the number to depreciate. Okay, here they're showing us what they actually paid. I said 100,000. They got a good deal. They got the truck for $80,400, and they're going to depreciate it over 4 years, I guess. Okay, so after the first year, look at the journal entry. They're debiting an account called depreciation expense. It's an operating expense, and they're going to credit the contra account, not the 80,400, but the contra. And notice that this grows every month. Okay, contra account. Companies love depreciation expense. They love depreciation expense because that is an expense that doesn't require spending even a penny. So companies love depreciation expense. Chipotle's is a big company, right? Let's say that 20,100 number there is really 20 million, and I bet it really is 20 million. That means it reduced their income by 20 million, which means they saved 30% of that in taxes. So that depreciation account there was worth $6 million in cash tax savings. That companies love depreciation expense. And I'm not going to go into it in detail now. There are strict GAAP rules on how you can record depreciation expense. You just can't say for tax purposes, let's depreciate the whole 80,400 today. Then we won't pay any taxes. No, it's got to be a rational, systematic and rational. Numerous expenses are incurred without being paid. Salaries, utilities. These accrued expenses are recorded over time, but not recognized till the end of the period. And that's kind of what we were just talking about. We just have a few more slides and we'll get us out of here. Salaries and wages. That's the last week. Chipotle's employees earned $13,000 the last 2 days of the month. That happens to be the cutoff in terms of the calendar vis-a-vis the fiscal period. They're going to get paid next quarter. But we, the management of Chipotle, we have to understand that that money they earned in this month belongs in that month. We're going to debit salaries and wages expense, and we're going to credit accrued expenses or accrued wages payable if they want to separate it. Okay. Remember, an accrual is a payable. It's just a temporary payable. So by debiting the expense here and crediting this liability, we have recorded the proper expense in that period of time. And here it is again. The 138,600 number, that represents the amount of people who have worked this month and have already been paid. It's just these last 2 days that we have to accrue. And we accrue it with a debit to expense, salaries and wage expense, and credit accrued payables, accrued salaries payables, whatever they want to call it. They already had a balance of 1,600 in there, and now it's up to 15,000. Notes payable. Chipotle owes 233 in notes payable. Notes payable. The average interest rate is 7.7%. Wow, that shows you how old this book is, huh? Was the expense incurred but not recorded? Yeah, of course it was. We have to come up with the interest expense, debit it. We're not going to pay it for a while, but we have to debit it and credit another accrued payable account. Accrued expenses dash interest, something like that. And again, here is our famous chart of accounts, our general ledger. And you debit interest expense and you credit accrued expenses. For purposes of this chapter, they're putting all of the accrued expenses under a heading, accrued expenses payable. In reality, you'd probably have separate accrued accounts for the bigger items. Utilities, man, we talked about this one a lot. We don't have the electric bill yet, but it's been running $4,000 a year. Let's bump it up to 4,400. A defendable number, an estimated number. You debit the expense and you debit the expense right here, the 44, and you credit the payable. Credit the payable. Income taxes. We all like to talk about income taxes. They estimated a tax rate of 38.9, okay? And they had pre-tax income of 102,700. So I think we're talking close to 40,000, huh? Whoa, what a coincidence. It came out exactly 40,000. Net income 102 times 0.389 represents the income taxes that they're not going to have to pay for a while. If this is just 1 month, they're not going to have to pay that amount until a year from now. But it's an expense for that month, not an operating expense, but it's an expense and a liability, a payable. And again, they're showing you here, we're building this accrual account into the various expenses. Question of ethics. I'm not going to go into this here. Just want to look at it real quick. Yeah, the temptation there, I think they're talking about, is you get paid in advance and you're so tempted to record it as revenue when you can't. Let's take a little stroll through the financial statements, and we'll get out of here, huh? The income statement goes first. It must be done first. Revenues minus expenses gives you the net income, because that net income is now going to go into our little template here, which is beginning inventory, beginning retained earnings, plus net income minus dividends gives you the ending retained earnings. And once we have the ending retained earnings and the rest of the equity, we can move it all over to the balance sheet. Income statement, equity statement, balance sheet. Here is our adjusted trial balance. And they're making an amusing note to me. Note, cash did not change because cash is never adjusted. You can never have cash on an adjusting entry. Cash is not like straws. We don't send somebody into the safe and say, Ian, would you go out and count the cash? And you come back in, you say, well, we have $350,000 there. And I say, okay, write a journal entry to adjust the cash down. No, the cash has to be to the exact penny. But the point is, here is the adjusted trial balance. Take a look at the property and equipment. Remember that truck we bought? All their equipment here adds up to $1,217,100. This is what they paid for all their equipment. This is how much they've depreciated so far. The difference between those two is called the net book value. And they're taking us through the rest of the trial balance, huh? And here's the income statement. I'm not going to go into detail on this. I'll do it in the next class. But here's the income statement they did after we popped in all those entries. The revenues were here, and look at all this stuff. Remember the 206 and the 152. These are the entries we kind of just rolled in there. Income statement, net income, bottom line after taxes, 62,700. They went a little bit out of order here, but that's okay. I just want to show it. Statement of equity. Remember the 62,700? Here it is. Here is your stockholders' equity section. Common stock, paid in capital, and retained earnings. What earnings did we retain this year? 62,700. Any dividends would get subtracted from that. We now have a total stockholders' equity. I can't read that number, but that's okay. Oh, hold on here. We have the total equity down there in the lower right. And now it comes over to the balance sheet. The balance sheet. The balance sheet is your accounting equation. Assets equals liabilities plus equity. And here they're breaking out the current assets from the fixed assets. Current assets are listed in order by liquidity. Okay. I did see this, and I want to talk about this. I think you find this interesting. I would hope I'll use the word hope. I would hope that you, throughout your working career for the rest of your lives, you take advantage of the stock market and invest wisely. You can invest very aggressively and make a lot of money, but run a risk of losing money. You can invest in companies that are very solid. You know they're going to be okay. It's just that they're not going to go jumping to the roof. Anyway, when you're looking at a stock, earnings per share, what an important number. Earnings per share, the net income divided by the outstanding shares. So let's see. Chipotle, they had outstanding shares of 36,217. It's technically the beginning shares outstanding averaged out with the ending shares, okay? So the outstanding shares were 36,217,000. And here they're putting all the zeros in to make it look fancy. So they had 36 million there. They had net income of almost $63 million. So Chipotle's earned $1.73 per share. Well, that's $1.73 that could go to the shareholders in the form of a dividend. At my age, I have tended to buy stocks that pay a steady, almost guaranteed dividend. It's kind of what I live on. Here, Chipotle. Cash flows, we're not going to worry about cash flows here. Not going to worry about the turnover. And I tell you what, we'll cut it off now because I think that was quite a lot for one session. And Friday, we'll hit chapter 4 again more quickly. And we're really going to go through the closing process, okay? What do you think, Ian? Do you have any questions, any comments?
I'm doing good so far.
You okay?
Yep.
Melanie, anything you want to say?
I think we covered most of the stuff. If not, I always rely on the tutoring hours at 5.
Oh, that's right. Oh, yeah, I got a tutor tonight, right?
Yeah.
You there. Brianna, you want to say goodbye or any exciting news?
No, I'm good. Thank you.
Okay. Brianna, do you want to make a motion to end the class? Is your son there? I hear your son. Can I see him?
I second. Sorry.
I'm sorry, guys. Our meeting is over. I'm just going to goof around with the baby for a moment. Not the baby.
All right. See you later, Professor.
You take care, Ian. Maybe see you tonight. Take care, Melanie.
Yeah, you as well, Bob.